So here comes the reconciliation part. So reconcile variable costing and absorption costing, net operating incomes, and explain why the two amounts differs. Well, a little taste we just had in our previous slide that it is mostly because of fixed overhead cost of ending inventory. So let's explore this one. So comparing the two methods, so recall our Harvey company data for that example, which is our basis of this chapter. So under absorption costing, 120,000 is our fixed manufacturing overhead that we already included here, right? Here. And the ending inventory is 30,000, which is the amount of fixed manufacturing overhead that is deferred under ending inventory part. So under variable costing, the entire 150,000 we expensed is under period cost. So I'm just gonna remind you guys here. The absorption costing, the product cost is, sorry my handwriting, direct labor, direct material, and manufacturing overhead. Which kind of manufacturing overhead? Fixed plus variable. But under variable costing, direct material, direct labor, only variable manufacturing overhead is our product cost. It means fixed manufacturing overhead on both ending inventory and cost of goods sold, that will be period expense, right? So that is the biggest difference between these two costing methods. So the difference between the operating incomes of both absorption costing and variable costing is because of the fixed manufacturing overhead cost on the cost of goods sold plus the fixed manufacturing overhead cost on the ending inventory that would be deferred for future. So another method we can also compare the two methods, very easy method, that is you just divide fixed manufacturing overhead by the unit produced. So 150,000 divided by 25,000, answer is 6. You just multiply 6 with ending inventory 5,000, 30,000 is here, right? And we know that variable costing net operating income is 90,000. We just added, answer is absorption costing net operating income. Understand? Okay. So up till now we have just covered the first year data, right? So let's expand the comparison of income of the Harvey company for the year 2. So Harvey company sells 30,000 units in the in year 2. The selling price is 30. Beginning inventory, which is the ending inventory of year 1, so that figure came from there, 5,000. This year they manufactured or they produced 25,000 units. The same segregation, 10 is a variable cost, which will include direct material, direct labor, variable manufacturing overhead, and variable selling expenses 3 per unit. Fixed expenses are here, right? So let's move further and try to see what happened now. So we know that under absorption costing, our unit product cost is 16 because we also include fixed manufacturing overhead as well. So here it is. So unit produced 25,000 and 150,000 is the fixed manufacturing overhead. It is 16. So under variable costing, the unit product cost is 10 because variable costing only include direct material, direct labor, and only variable manufacturing overhead part. So the net operating income under absorption costing. So in year 2, the company has sold 30,000 units, and 30 is the price, so 900,000 is your sale. So from the last year, the beginning inventory is 5,000, multiply the unit product cost under absorption costing. 16 you multiply with 5,000 units, 80,000 is here. So units produced this year 25,000. Again, the unit product cost under absorption costing 400,000. So total 480,000 is the cost of goods available for sale, and we less the ending inventory. When we less the ending inventory, which is here, is 0, so all amount is 480,000 will go to cost of goods sold. So answer is 900,000 minus 480,000, 420,000. 420,000 is our gross margin. Then we less at selling and admin, both variable and fixed. Fixed is 100,000 and variable this 30,000 units sold multiplied by the 3, answer is 90,000. So 190,000 is the result of both variable and fixed selling admin expenses. With less 190,000 from 420,000, answer is 230,000. So under absorption costing, our net operating income is 230,000. So here comes our variable costing. So under variable costing, the format is sales minus all variable costs. I just write here total variable cost. We have CM, and then we have total fixed cost, and then we have net operating income, right? So just keep in mind that format, because that is variable costing income statement form, right? Okay, so we sold 30,000 units. 30 is our per unit selling price. 900,000 is our sales, and then less all variable costs. So we know that our beginning inventory is 5,000, so 10 is our unit product cost under variable costing. Is multiplied, answer is 50,000. We manufactured, cost of goods manufactured here 25,000 multiplied by the variable costing unit product cost 250,000. So when we added goods available for sale 300,000, but we also need to add, because there is total variable cost, we also need to add variable selling and admin, and we don't have any ending inventory, so the variable cost of goods sold is 300,000. We add variable selling and admin, so 30,000 units are sold. 3 is the per unit variable cost, answer is 90,000. The total variable cost is 390,000. So from 9,000 on you less 390,000, answer is 510,000, and then you less all the fixed expenses, fixed manufacturing overhead and fixed selling. You just less it 150,000 and 100,000, total 250,000, answer is 260,000. But did you notice one thing? The absorption costing income statement is results 230,000 net operating income, while this time the variable costing method under second year, so this data is for second year, it results even bigger income than absorption costing. So what are the reasons? right? So let's explore these reasons. So the reason is that in the second year, variable costing operating income is 260,000. Then just deduct the effect of fixed overhead costs that we deferred. Let me just write it here. In year one, what we deferred, we added over there the fixed manufacturing overhead. So that part of variable, fixed part, that is 5,000 multiplied by 6. Answer is 30,000. So that is exactly the amount for year 2 variable cost absorption costing net operating income, right? So you can also find out what is the fixed overhead per unit. The fixed overhead 150,000 divided by unit produced 25,000. Answer is 6. 6 multiplied by 5,000. Answer is 30,000. So that 30,000 that is deferred from the ending inventory in year 1, which is the beginning inventory of year 2. So that fixed part is now, if you deduct from variable costing, then that equals to the absorption costing net operating income. I hope you understand that. If you do not understand all this, then let's discuss it by posting our Blackboard discussion board under week 2, or WeChat discussion forum, or you can join our live Zoom meeting and then we can talk about that. So here's a very nice concise explanation here. So across 2-year time frame, both methods basically report the same total net operating income. So if you total absorption costing first year income, second year income, answer is 350,000. So 2 years cumulative total net operating income is 350,000. Same here with the variable costing, 90,000 to 60,000. Answer is 350,000. So the difference between is the amount of earning in each period, right? So now here is the managerial decision making, and that the shorter the time period, the more the net operating income figures will tend to differ, right? So if you choose one period, then answer is different. If you choose longer time horizon, then answer is closer towards the total of the net operating income. So which one is better? That lies under the objective of the manager. If manager wants to show on first year highest income, then the absorption costing, my writing, will result in first year highest income statement, net operating income. But for total, there is no effect on choosing of either method. So but which one is more meaningful? Answer is variable costing. Why? Because it follows CVP analysis as well, and we know that how CVP analysis is applicable to the daily or day-to-day managerial decisions, like what to sell, how much to sell, how much cost we control fixed cost, how much is the profit if we increase the fixed cost or the variable cost, and etc.